Hi there. Today we'll talk about accounting standards. Now, a doctor follows standards to treat the illness of the patient. The architects follows standard to design a building. Accountant also follow standard to report the information in the financial statements. Now, let's concentrate on our accounting standard. These accounting standards are written by accounting committees. We call them the accounting setter. Those who write these principles or these standards. Like, for example, in the United States, they have a board, and that's board called the FASB, or the Financial Accounting Standard Board. Whereas within the international accounting, also there's a board, which is again the accounting setter, but it's called the ISB, which stands for International Accounting Standard Board. Now, these standards, in fact, are managed and controlled by generally accepted accounting principles. Again, we call them in accounting, we call them the GAAPs. These GAAPs are like accounting laws or like accounting rules that shows that information need to be or the treatment of the information and of the account need to be followed by all the peoples or all the organization. Now, the main aims of the GAAPs or the generally accepted accounting principle is to show the information and make sure that the information or the financial information are relevant, reliable, and comparable. So that means relevant information is affects the decision of its user, whereas reliable information is trusted by the user, whereas comparable information are helpful to constructing the organization. Now, in the United States, and we usually, not only me, okay, many people refer to the United States because there is no doubt that the United States has the best and the strongest and the highly rated and more sophisticated, GAAP or General Accounting Standard, General Accounting Standard or Generally Accepted Accounting Principle. These GAAPs are created, in fact, by two organizations in the United States. The first one, they call it the SEC, which stands for Security Commission, Security Exchange Commission. Okay, Security Exchange Commission, the SEC. It is a governmental organization. At the beginning, it was responsible for setting the organization, but later on, the responsibilities of the SEC are many. So they have also legal aspect. You have to look after other companies. Therefore, they delegate the job of setting the standard to accountant or to private organization, which consists of a group of accountant. They are, of course, sophisticated and well-educated accountant. They call them the FASB, as I said before. So it stands for Financial Accounting Standard Board. Now, in accounting, there should be at least 4 principles and 4 assumptions and 2 constraints. And at the top of that, there should be one important key concept, which is called ethical concept. Because, as I said, the aims of all these studies, all these topics, all these job, or as I said, the aims of the concept itself, the generally accepted accounting principles, are to show the information relevant, reliable, and comparable. Therefore, we need the ethics before we start even talking or creating the other principle or assumption or the constraint or other concept. So ethic principle is the keys. It's very important. Now let's go and talk about these 4 principles. That does not mean that there's only 4. There are many, but as I said, at least there are 4. And because of the time, so I will try to summarize each one in one line, just to understand or to grasp the idea of this standard. The first principle in accounting, we call it the cost principle or the measurement principle. This means that all the assets and the liabilities, and for those who have no idea about the asset and liability, all the items in the business must be reported at its cost. Why cost? The purchasing price, because it is more objective. It is more objective than the market price, more objective than, let's say, the liquidation value. I'll give you example just to make your life easy. Let's assume that the company purchased a building, and that building cost the company 50,000 dinars. Okay, so the company or the accountant recorded at 50,000. Let's assume after 1 week the price of the building goes up and it's become 60,000. So the accountant is not allowed to change it to 60,000. Why? Because if he change it to 60,000, he is not using the most objective value, which is the cost. He is using the market value. So he's follow the market price. And let's assume it is the opposite. Now, after 1 week, the price of the building goes down and it's become 40,000. Again, the accountant cannot change it to 40,000 because if he change it, he is using the liquidation value, and it is not, of course, for the benefit of the organization. So therefore, the accounting sitters allow the companies or the organization to use the cost or the measurement principle because it is more objective. Of course, that does not mean that they cannot use the market value. Nowadays, some items like, for example, investment, okay, and some part or some example of, let's say, asset also, they use the market value. But again, that will take us to other situation or other field or long field. So we say, I don't want to talk too much about it. But as I said, so this is in the idea of the cost principle. All assets and liabilities or all items must be recorded and reported in the books of the company at their cost and their purchase price because it is more objective. The second principle, we call it the revenue recognition principle. Why revenue? Revenue is very important. Revenue is the sales. So because of the sales and from the sales we generate the income, so it's need a rules, it's need a concept, it's need a principle, and this principle is called recognition. And under this revenue recognition, we have to bear in our mind that revenue is reported in the account when it is earned. It must be earned. And by earning the revenue, we mean that the ownership of the goods or the service is a transfer from the seller to the buyer. Now, number 2, they said there is no necessary to exchange the cash or the money. And this is why we notice that most of the business are on a credit nowadays. And because of most of the business are credit, so again, we can say when it is earned, it does not mean the cash is exchanged. Maybe I say I'll pay you later. Usually say I'll pay you after 3 months or maybe 1 year or 6 months. So it is allowed, okay, in business. Therefore, we have to bear in our mind that revenue, as I said, is reported when it is earned and not necessary by exchanging cash. Number 3, when cash is exchanged. Now, this is why some organization, but most of the organization, especially the large one or the giant, use the accrual concept because of what they say that we have to earn our revenue regardless the receipt of the cash. Whereas in small businesses, usually the partnership business or the sole proprietor business, they use the cash concept or the cash accounting concept. Now, number 3 is the matching principle, or we call them expense recognition. What here is very important because how we generate our revenue, or sorry, how we generate our profit or income. We say it from via the sales, via the revenue. But in order to generate the revenue, we have to incur expense. Therefore, in order to calculate our profit, we have to match, we have to compare our revenue with our expense, because these are the expense which are generated, or sorry, they are the expense which are earned. Here again, whether it's paid cash or not cash, in order to make or generate the revenue, in order to make a profit, but maybe make loss on that. Therefore, matching principle again is important. And number 4, we have full disclosure principle. That's mean we have not to mislead our user or reader of our financial statement. We have to explain everything for them in more relevant, reliable, and comparable information, and we call these part notes to the account. After the statement, okay, if you look at the annual report of any company, you look after the statement of the state of financial statement is usually followed by notes to an account, and this is why, because of the full disclosure principle, which is forced by the accounting standard like FASB, as I say, or ISB in the international accounting. Now let's move to the assumption. Again, in accounting, we have 4 assumptions. And this assumption, the first one is called the going concern assumption. That means you have to presume, or we have to presume, or you have to assume that when you are doing your accounting, reporting, recording, you have to bear in your mind that the business will continue forever. It will not be disclosed in the near future. Why is that? Because remember, in the principle, we use the cost principle, which is more objective. So if I assume the company is going to be, for example, liquidated, or the company is going to be closed down next year, or maybe after 3 years, or even 10 years, that will help me or guide me to use either the market price, but more worse, to use the liquidation value, as I said. So therefore, the account measurements are not objective. So we have to go back to our cost principle, and the cost principle here is related to the going concern assumption. We have to assume that the company will continue forever. The second assumption is called monetary unit assumption. You know that in business we are dealing, in money term, because money is a medium of exchange. So therefore, all the transactions need to be recorded and reported. And when we talk about the value or the cost and purchases and the sales and whatever is that, it should be in money term. That's either in dollars or in euros or in the pound or in the dinars. Again, we have to record them in money term. I cannot record for number of items. I say, well, in the balance sheet, for example, I say asset is equal to 5,000 tons of inventories. No, I can't try that. I can say it cost 50,000 dinars or 60,000 euro, whatever is that. This is the second one. The third assumption, we call it time period assumption. Now, companies and businesses are allowed to use artificial time period, and the period is of the financial of the financial statement are, in fact, it's open for all organizations, although most companies, and although it is preferable to make it for 1 year, at least for 1 year, but some company they do it for 6 months. Other company, they prepare their financial accounts and report for 3 months or quarterly. Some of them, they do it monthly. Believe it or not, some of small organizations, they do their accounting every day. Every day you go, they prepare the financial statement. But of course, this is what, as I said, it is very rare, but they are allowed. This is the meaning of the time period assumption. Number 4 is very important, which is called the entity or business entity assumption. Business entity assumption presume that we have to make a separation between the business transactions or economic events and the personal transactions or economic events. I'll give you an example. Let's assume I am a sole proprietorship or small traders. So I have my, let's say for example, small shop, my boutique shop, plus I have my personal accounts at the bank. I have saving account and current account. Now, if in accounting, we should not amalgamate them together. We should not mix them together. Yes, this I say, for example, I say, this is my shop and this is my accounts. I cannot use the money, okay, in the shop together with my money in the personal account. Otherwise, I'm not giving for what good information, accurate information. So we should not mix them in. Also, companies can do the same. Giant companies, for example, assume a company has 3 types of businesses. Okay, let's say it is, say, small producer or manufacturing, plus also it is what it has, let's say, selling computers. Number 3, also make the surface for the computer. Now, it has 3 types of business. We should not add them together and say, this is the financial statement of XYZ company. It is 3 companies. We have to show separate information. Separate information. Even if this company or it is a parent company which has a subsidiaries, we should not mix them together. All accounts need to be shown separately, accurately, for easy comparable. It should be relevant. It should be also, as I said, reliable. Now, let's move to the constraint. We have 2 constraints. The first one, we call it the materiality constraint. What is that? Materiality means that, of course, I cannot add or record or report every single items in my box or in my account. Some of them, they are peanuts. So therefore, only the items which are materials and affect the decision making, we have to show them, and we have to show the note for them, and we have to do the calculation, as I said, the cost principle, we have to use the money term, we have to use the time period. All these need to be material. Now, some organization, what they do, they said, but if we add them together, it will give us a giant amount, big amount. It is important for decision making. Yes, it is allowed. So organizations are allowed to add these peanuts together to have a good figures, and they can do or they can report it in their box. Number 2 is very sensitive and very important. It is called cost benefit. Cost benefit constraint. That's mean before I create or build or make an accounting system in my organization, I have to count it carefully. I say how much it will cost me and how much I will benefit from this system. If the benefits exceed my cost, I will go with it. It is important, it is necessary, especially if I am a giant organization, I need it. Believe it or not, some organization, even their cost at the beginning of like first year, second year, exceeding the benefit, but they go for it because it is a must. as I said, by the accounting sitters. Okay, so you have to do it, and that will give you benefits for, I say, at the end of the day for you and also for the user of your accounts. Okay, again, going back to the three important elements of accounting standards, or the reason for accounting standard, and the reason or the aims of the concept, the three main aim of the concept: to show information that are relevant, they are reliable and comparable, as I said. But for a small organization, they have to be very careful. If the cost exceed their benefit, they don't need this system, and they have to work a little bit harder in order to until they benefit from this system, and then they say go for it. Now, this is just a summary. In fact, if I want to talk about the principle, I need 1 full days, and I need a book to say to write and to talk about it and to explain to you. And thank you for your patience. Thank you for your listening. Thank you for your good attention. Thank you very much. Goodbye.